Greetings, Ted Hicks, founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Monday, October 3rd, 2022. This is our monthly market monologue, so thanks for watching. That said, before I dive too far into it, I want to encourage everybody, if you're not already connected with us on Facebook, if you're not connected with me on LinkedIn, feel free to join us on those platforms. But also love your feedback. If you make a comment, do you prefer the longer version of these monthly market monologues, or do you prefer the shorter versions that we've been doing perhaps every week? So leave us your thoughts, and we would greatly appreciate it. That said, please do make sure that you subscribe directly on YouTube. And again, if you connect with us there and Facebook, you'll see all of our video content. We only send out an email pushing the monthly market monologues. Usually we only send that out once a month, but we frequently publish more frequently than that. That said, let's take a look at the latest estimate from the Atlanta Federal Reserve and their GDP Now tool. So on the screen right now is a screen grab that I took from the Atlanta Federal Reserve's website earlier today. Honestly, haven't not digested this just yet, but did want to share the news with you. And again, you can find this data yourself if you'd like on Atlanta Fed's website. The green line is really what we're talking about. As early as last week, Atlanta Fed was estimating that the third quarter GDP was going to come in at about 0.3%, 0.3%. Well, this week it has jumped. So they're now estimating GDP for the third quarter to be approximately 2.4%. Remember, first quarter and second quarter GDP were both negative. They were barely negative, but they were technically negative. So it would be very interesting to see if third quarter GDP did indeed jump. It would also be very interesting for us to see once the revision is done, which I think would come out in November, I think, maybe December, but it'll be interesting to see how those stats hold. So on this screen, we have the Consumer Price Index, or CPI, or inflation. Right now, this is really enemy number one. We are currently at approximately 8.2, 8.3, somewhere in that range. And then we have, this is core CPI. Core CPI is the regular CPI less food and energy. Remember, this is the metrics that jumped this past month. Everybody was expecting it to go down, but indeed it went up. So inflation remains enemy number one. To that said, I thought I would give a little bit of a plug for a friend of mine. Dr. Richard Salzman is going to be giving a presentation next Wednesday, the 12th, hosted by the American Institute for Economic Research. It's going to be hosted at McGregor Downs Country Club right here in Cary. The website does say registration is required. It's actually suggested, it's not required. So if you get this and you want to join us, feel free to come out and hear what Dr. Salzman has to say. Again, 5:30 at McGregor Downs Country Club. If you have any questions, feel free to reach out to me. I'll help you out, or just Google AIER, Bastiat Society, and that's how you spell Bastiat, and come out and join us and hear what Dr. Salzman has to say about inflation. That said, one of the things that we are really zeroing in on is whether or not we are in a recession, or whether or not we're going to see a recession. As a reminder, the first and second quarter GDP stats were indeed negative, and according to the Atlanta Fed, now the third quarter estimate is going to come in maybe as much as 2%, 2.4% is what they're estimating. But the yield curve is something that we continue to look at. This is on the screen is the 10-year yield minus the 3-year yield, and you can see it's currently negative 0.43. And what I really want to highlight is just how negative it is. And then let's also zoom in a little bit. Here again is the same chart. All I'm doing is zooming in, and we're definitely in a downtrend with these yields. That is not a good indication or a good omen, if you will, for where the economy is going. So switching gears now and talking about the federal funds rate. The federal funds rate right now is approximately 2.3%. And you can see the black line on the chart represents 3.4%. 3.4 is the current consensus estimate on where the federal funds rate will be by the end of the year. Now, one of the things that's important to me is that we try to convey that our job is to look at data and it is imperative that we look at data with an unbiased eye. So a couple things that I see here is, number one, we have definitely seen periods where the Fed funds rate is higher than the current levels. The level itself is not my concern. The concern obviously is the rate of change. We have gone from 0 to 2.3 very, very quickly. And again, we expect to be about 3.4%. And of course, this rate permeates throughout the economy, and we'll show you that in a second. Now, I also want to highlight back in April of 2019, the rate was about 2.45%. So we are getting really close to getting above where we were in April of 2019. As the interest rate has risen, it has had an impact on housing starts. So on the screen right now, again, is data taken directly from the Federal Reserve's website. And this is the new housing starts. And you can see that during the pandemic, obviously that plummeted. We recovered fairly quickly, and we reached some new highs. And that as interest rates have risen, new housing starts have come down. Now, the good news is we're starting to see some of that pick back up. And perhaps contributing to that is the price of lumber. Here's good news, bad news. So on the screen now is an ETF. It's wood. You can see the watermark here. This is a wood ETF. It is really the global timber and forestry ETF. So this is not the spot price, if you will, for lumber, but the lumber spot price does mirror this pretty well, and this is an easier chart for me to make. So what I want to highlight is the fact that lumber prices, as measured by this wood ETF, have definitely come down. That's the good news. So that is some of the deflationary impact that the Federal Reserve is trying to create. They're trying to create effectively deflation to get rid of the inflation. And what you see is the price of wood has indeed come down. That's the good news. The bad news is we're all the way back to pre-pandemic levels, and you're going to see that level again in just a minute. So let's go back and talk a little bit more about interest rates. On the screen now is the average interest rate for a 30-year mortgage. This is a nationwide average, and what you can see is that as the federal funds rate has increased, that has corresponded to a dramatic rise in the average 30-year mortgage. But again, as I mentioned a minute ago, our job is to look at data in an unbiased fashion. So when we look at this, we have seen mortgages above this level before, okay? So again, that's not the big question. The big question and the concern is how much higher will the interest rates go? I was reading a research report just last week by somebody that was parsing or splitting the hairs, if you will, of Chairman Powell's latest talk. And this research analyst was suggesting that what Chairman Powell meant was that the Fed funds rate could actually be risen above inflation, which would mean the Fed funds rate would be above 8%. That would be fairly dramatic, and that would obviously have an even bigger impact on 30-year mortgages. And the reason we're talking about housing starts and mortgages and the price of lumber is housing starts do have a very big impact on the economy. So that is definitely a concern. Now let's talk a little good news. A little good news is household obligations. If you watched our brief video that we published last Friday, I believe this was in there. This is household obligations. And, yes, obviously from the pandemic, household obligations, in other words, debts, have risen. So the American consumer has taken on a little bit more debt here recently, but take a look at this level as it relates to history. We are still very much below where we have been as a nation in terms of household obligations. Now, I would be curious, I haven't seen data to affirm or deny this, but I wonder how much of this is impacted by the baby boomers who are paying off their mortgages. So I would be very curious to see if there's a way that we can get a household obligations ratio by generation. And that would perhaps be very, very telling. But anyway, for right now, I think the American consumer on average is in a fairly good spot to weather a recession. Now, that said, I said it again in the brief video from last week. If you are not recession ready, we strongly encourage you to be recession ready. And that obviously is more applicable to those of you that are still working. So let's switch gear and talk a little bit back to bad news. This is business inventory. And the fact that business inventory has risen and has not really coming down, obviously there was a peak, but it really is not starting to come down. That's telling us that businesses the inventory is growing. In other words, consumers are spending a little bit less. So this is a bit of a concern if we don't see that stat come back down. Now, when we talk about inflation, this is actually one of my bigger concerns. This is the total federal debt. And really, this is a bipartisan problem, folks. Our national debt has been rising steadily. Now, remember, the bottom of the chart does not equal zero. The bottom of the chart here is 32%. So when President Reagan took over, he did a lot of good things, but he went on a very large spending spree to boost national defense, if you will, and which ultimately led to the winning, if you will, of the Cold War. That's good news, but we have not been paying this down, folks, and this absolutely contributes to inflation. So we really need to see the total federal debt come down at a much higher rate. We're going to begin to land the plane, so only a few more slides to go. These last few slides are really designed to try to keep things in perspective. Overall, my team and I are very pleased with how we have navigated the current stock and bond markets. But we need to keep things in perspective. And so on the screen right now is the year-to-date return for the S&P 500 is in this bold red line. Every year since I've been born is on the screen represented by an individual line. What I'm trying to highlight here, folks, is that this year, 2022, is one of the worst years. As a matter of fact, since I've been alive, there's only one year where it was worse at this point in the year, and that ends up being 2002, okay, which also was a midterm year. We'll come back to that in a second. So this has been a very, very tough climate. Now, when we want to look at, that's the stock market, that's the S&P 500. Now this on the screen is several bond ETFs. And what I'm trying to highlight here, folks, these are negative numbers. These are bonds. Bonds are supposed to be the safe haven. So when the stock market is having a tough year like it is this year, historically, investors can turn to bonds and find some safety. Well, that's not been true. We've got bonds negative 5% all the way to negative 35%. This has been a very, very tough year. As a matter of fact, the Bank of America analysts recently stated that because of the twin declines in stock and bonds this year, this is the worst year on record since 1938. That's horrible. It really has been a tough year. Now, I just said that this is a midterm year, and we've talked about this throughout the year, that historically during a midterm year, the markets are kind of flat to maybe slightly downtrending, and then as we get closer and closer to the election, the markets turn a little higher. Now, this is the second half of those midterm years since 1974, and just the naked eye, you can see an upward bias. So I, for one, certainly hope this year that trend continues and we see an upward bias over this last quarter of the year. No promises, but this is just what the data suggests. Now, the other thing that we've tried to use to help keep things in perspective is on the screen now is the proverbial 60-40 portfolio. Many times you will read in newsletters and news articles that a standard 60-40 portfolio is kind of a common recommendation, especially for somebody who wants to be passively invested. In other words, you don't have someone like me and my team working for you. You just put your portfolio in a 60-40 portfolio and rebalance it once a year, where 60% of the portfolio would be in equities and 40% would be in bonds. Well, the 60-40 portfolio year to date, that's the green line, it's negative 26%. Okay, so there really has been very few places for you to hide. And so part of the objective of what I'm trying to show here is just to keep things in perspective. Again, I said this a minute ago, that according to the Bank of America analyst, this is the worst year since 1938. It has been very, very difficult. So when you're looking at your statements, your portfolio's rate of return, keep this in perspective. Now, again, the Dow Jones Industrial Average as of Friday's close was negative 21.5%. The S&P 500 as of Friday's close, negative 25.25%, and the NASDAQ negative 33%. But folks, it gets a lot worse than that. Now on the screen, I've got several different stocks. I've labeled this soldiers versus generals. We've talked in the past about how the broad stock market indexes can be considered the generals, and if the generals are advancing, in other words, the broad indexes are advancing, but the soldiers are in retreat, meaning the individual stocks. If the broad market is advancing, but the individual stocks are retreating, that's not a healthy stock market rally. So right now, we've just got some very big names on the screen to show you where we're at. Netflix is down 60% year to date. Apple is down 24% year to date. Microsoft down 30% year to date. Facebook is down 60% year to date. Amazon is down 34%. Google, or Alphabet rather, down 34%, and the S&P 500, of course, in there at negative 25. So it is a very, very tough environment, and this picture here, this chart here, will really solidify this. Right now, on the top pane is the S&P 500. This middle pane is the percentage of the S&P 500 that is above the 20-day moving average. What that's saying, as of Friday, only 1.8% of the S&P 500 was above the 20-day moving average. I believe the math works out. That means there's 9 stocks out of the S&P 500 that are above the 20-day moving average. Now, 20 days is approximately 1 month in the stock market trading days. Now, the 50-day percent of the S&P 500 above the 50-day moving average, that measure is only 2.6%. That works out to be approximately 13 stocks out of the S&P 500 are above the 50-day moving average, which is approximately 2 months. And then the 200-day, we've talked about the fact that the 200-day moving average is generally considered the indication about whether or not something is in an uptrend or a downtrend. That measurement is 10.5%. Only 10.5% of the S&P 500 is above the 200-day moving average. So that's about 50 to 53 stocks that are above the 200-day moving average. That is very tough environment. There's not a lot of stocks that are performing well. Now, the good news here is that these stats can't get much worse than that. And I don't have a chart for this, but one of the things I was looking at this weekend and some of the research that we provide to some advisors is that there is extreme bearishness right now. And when we see so much bearishness, when there's so many people that are pessimistic about the stock market, that's actually what we refer to as a contrarian indicator. If you look at the news in particular about the stock market, they're very negative, which is good because it's been a very difficult year. But by the time the news media really latches on and starts discussing the stock market and then talking about bear markets, that can very much be a contrarian indicator where the market actually starts to rally. So a couple other slides. This is the S&P 500 on a monthly candle chart, and all I'm trying to show is how difficult September was. September, the S&P 500 was negative 9% in a single month. That's pretty tough. And you can see I've labeled this slide pre-pandemic levels. And now on here, I've got some green lines marking some what are referred to as support zones. So when the market starts coming down, The market found a bottom here, it rallied, and then it came back in and it rested here for a moment or two, or for a couple of days, which led us to believe, or led a lot of market analysts to believe, that maybe these March lows are going to serve as support. Well, that obviously didn't hold. Then we made new lows in June and July. We bounced back up. Anyway, the point is that's what these lines are representing, is various support zones. Friday, the market broke the June and July lows. That is not good news. The good news is the next logical area of support is the September and October highs from 2021. The good news is that level is only about 1.5% away. The bad news is I'm not convinced that's a good support zone. A more logical support zone is actually dating back to the pre-pandemic levels, so the February of 2020 highs. That level is about 5.5% away. Now keep in mind, we're not predicting here. I have no idea if the market is going to turn around, if it's going to turn around today, if it's going to turn around tomorrow. I have no idea if the market is going to go even further lower, if it's going to hit this 5% drop, and then it's going to, we don't know. Our job as active portfolio managers is to respond to data and respond to the markets as it happens. That's why if you're a client of ours, you've seen so many trade confirmations this year, is because we are responding. And as a reminder, there's no commissions and there's no transaction costs when we make those changes. So there's no reason not to take action. So it's been a very difficult year. Again, overall, we are pretty pleased with how things have worked and how our process has played out. That said, I would be remiss if I didn't plug my friend's talk one more time. Dr. Richard Salzman, very smart individual. We'll talk next Wednesday, the 12th, at the Bastiat Society monthly gathering. It's always a good time. It is free. Obviously, they suggest a donation to help cover the food and beverage that will be served. If you can join us, feel free to come out. If you need help registering, by all means, feel free to reach out to me individually and I'll help you get registered. That said, I thank you for watching. Again, please make sure that you've subscribed to our YouTube channel. If you have any questions, feel free to reach out to me or any member of our team. You do not need to be a client in order to reach out to us. We're happy to answer any questions. We'd love to see your comments. And again, thank you for watching.